Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Valuation for Beginners. My name is Shen Chu. I'm the moderator for this session. Now, when it comes to valuing a company, many investors often ask which is the best valuation metric to understand the true value of the company. So today, our speaker will share with us different valuation methods and how you can use them to effectively get the intrinsic value of a company. Now, before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mention here. If you decide to make any investment decision, you are solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. Now, he first indulged himself in the SMA financing industry right after finishing his diploma in finance and investment in Ta University College. He continues to pursue his interest in the finance and capital market by joining Rakuten Trade and TA Securities, which he held the position of risk and compliance officer and dealers representative. To date, he has over 7 years of experience in the capital market as an investor himself, where he also runs One to Invest, a financial blog which amassed over 60,000 followers to date. He's also the associate director for private equity firm Sensuria Capital Sdn Bhd. Currently, he is also a SGX Academy speaker. So he's none other than Mr. Max Tan. So Max, how are you today? Pleasure to have you here.
Hello, Shane, and good evening, everyone. Thank you for having me over today. And yes, I'm doing fantastic.
Perfect. So I'll stop sharing my screen and hand over the control to you.
All right. Thank you very much. Let me share my screen. Okay. Good evening, everyone. If you can see my screen clearly, can you please type in a hi so I can say greet you guys? And also, I know that whatever I share here is clear. Hi. Hi, Zaim, Vincent, Joshua. Okay, Jaislyn, Lau, Afnan, CK, Seng Ho. Okay, great. Good evening, everyone. So I presume my screen is very clear here. Now, today we are going to discuss a topic that is, I would say, quite sensitive because valuation is something that would create an argument. Because what I deem is value for a company, you might not agree. For example, if I think that this company might worth 5 ringgit, you might have a different opinion. You think that this company doesn't worth that much, maybe 2 ringgit only, right? But who is in the right? We will talk about different types of valuation, and we'll talk about why discrepancy between valuing companies, and also to break the myth that there is a one-size-fits-all kind of valuation to understand the value of a company, right? Okay, so let's jump into it. Now, because before I begin, I would like to do a quick disclaimer that by all means, I'm not a licensed financial advisor or research analyst or any kind of a licensed activities. This seminar or this webinar is solely for information purposes only, and hope that throughout this webinar, you are able to learn some of the ways that I personally use to value a company, and with that, you are able to better understand the true value of the companies going forward, right? Shane has already go through about my profile, so I'm not going to repeat that again. Right. So first of all, since this is a beginner-friendly session, we are going to first understand the concept of what is valuation, right? What exactly is a valuation of the company? If you have read a lot of books that are by value investors or by Benjamin Graham or by maybe some of the write-ups about Warren Buffett, you might see the term intrinsic value. Intrinsic value. So basically, intrinsic value, it means that this is the true value of a company, right? This is an intrinsic value of the company. This is the true value of a company. But I want to emphasize that, like I mentioned at the start of the webinar, everyone have a different opinion about the true value of a company, right? There's only reasonable and unreasonable, in my opinion, right? And to arrive at the intrinsic value, you have a lot of ways to calculate the valuation of the company. Number one, you can calculate the forward or future earnings of that company, right? For example, this year, the company is earning 10 million. Next year, you presume the company might double in terms of their profitability. Then you can forecast their future earnings and trying to predict how much they're going to earn. This is the first kind of valuation, right? Forecast their earnings. Number two, you think that this company is able to generate a stable stream of cash flow going forward, right? This is what we call DCF, discounted cash flow. A lot of people like it. Also, a lot of people don't like it because of the complexity. We'll talk about it, about DCF shortly after this. But some people would like to calculate the cash flow of the capability of the company to generate the cash flow in future, right? This kind of valuation method is more suitable towards company that are more stable, right? This is also one of the way to value a company by trying to figure out how much cash flow they can generate in the future. Then number three, we have a way to value the company based on whatever asset they have, which is the most common method. A lot of very traditional investors use is to base on their NTA, net tangible asset. So in short, net tangible asset means that the total asset of the company, tangible, is not excluding the intellectual properties or whatever that's not tangible. You cannot touch, you cannot feel, right? Not exactly cannot feel. Maybe let's say, for example, brand. You can feel the brand, right? But you cannot touch it. So it's something intangible. So that would not be factored into the NTA itself. In some cases, the NTA of the company might be low, but the total asset might be high because they have a certain brand in their asset, right? Let's say Coca-Cola is a very strong brand name. So like McDonald's, they have a very strong brand name. Of course, they have intellectual property as their asset, part of the asset. And then last but not least, some people would like to calculate what kind of dividend yield they would get by investing in a particular company. Normally, this kind of investor, they are investing in some, I would say, securities that are more stable in terms of giving you yield. Okay, let's say I'm just giving you an example. I'm not asking you to buy, but let's say if I buy Maybank, right? Maybank just got their result out recently and they're giving out 29 cents as the dividend. So you can calculate and you can figure it out that 29 cents will be my dividend yield. So I can assess what kind of yield I could get from my investment. So these are the common four types or methods that people would use to go to and value a company. So just a quick recap. Number one is trying to figure out the earnings of a company. Number two, trying to predict the cash flow of a company. Number three is trying to work out the balance sheet or the net asset of a company, which I'll talk about why this method is a bit hard for you to really execute. And number four is that the dividend that they pay you, you can use that to sort of value a company as well, right? But that, to me, dividend yield would be something that to help you and is only applicable in certain cases, right? So these are the ways to determine the intrinsic value of a company. Basically, it means that the true value of a company, based on my opinion, right? Different people have different intrinsic value. So why is it so important that we need to determine the intrinsic value of a company? That is because it's like you go to shopping, right? Whenever possible, we want to buy a product at discounted price. Unless you're super rich, then you probably want to enjoy the premium and you don't care about discount. But most of the time when we go shopping, we see there's a 50% discount, 70% discount. That is when we are interested to buy more. The same for the stock market. But the difference is when I go to shopping center, I know that this thing is really discounted by 50%. So that I know now is a good bargain to buy. But in a stock market, if you do not know the intrinsic value of a company, you do not know the true valuation of a company, there's no way you can compare. Even though the share price dropped by 50%, right? For example, like for the month of August, probably not a fantastic month for a lot of tech investor. So if you invested in tech stocks in Malaysia, then you notice that the share price probably dropped anywhere from 30 to possibly 70% lost in value. Then if you do not know the intrinsic value of these technology companies, is a 70% discount. is it a good time to buy, right? If you know the intrinsic value, then you know the answer. But if you do not know it, then there's no way you can assess it, right? And this is important for us and also for institutional investors. That means the fund managers to decide how they should invest in a company, which is the third point. The third point for retailer like us, like me and you, is very simple. We just need to figure out the intrinsic value and then decide whether it fits into our should I invest in this company, right? But for fund manager or for institutional investors, a lot of time they have a certain mandate or certain framework that they have to follow. If a company, even though they like the company, if it surpasses a certain threshold in terms of valuation, they might not be able to invest in a company, right? That's applicable for some of the funds. Now, a lot of funds, they are more flexible in terms of their framework and mandate, right? So it's really critical in terms of our investment decision making, other than understanding the fundamentals of a company, right? So understanding the fundamentals of a company is a critical part in our investment process. So yeah, I saw someone talking about a certain technology stock. If we have the time, we're gonna talk about it later on. But again, disclaimer, I only can share whatever I know. But back to this slide, okay? So basically, to understand the intrinsic value is critical for you to make decision apart from understanding what business does the company do, right? So for example, don't just look at some company, wow, it's so cheap right now, right? Let's say the company PE is 2, very cheap, but you do not know what caused the PE to be so low. Then if you jump into it, then I'll show you in the next slide what happens, right? And this one is a bit different because I'm also quite active in the private equity side. So a lot of times, these companies, they would also take up valuation to assess whether it makes sense for them to acquire a particular company. So why is this important? Learning valuation, why is it important for you? And what does corporate M&A have to do with me? So let's say if you're an investor of a company, your company is trading at, let's say, a price to earnings, PE ratio, of say 10 times, right? But then they are now buying into another company with PE of, let's say, 20, right? That means that your company is buying something much more expensive than whatever they are trading. Then you know whether does this justify the current valuation of a company, right? If they are buying with shares, then you have to be concerned because the dilution will be high. I'll try to explain in depth in terms of share swapping when you're accessing some corporate exercises. But if they're buying with cash, so your company is trading at 10 times, you're buying a 20 times PE kind of new subsidiary or new business. So you really need to assess whether this acquisition makes sense or not. And you can judge the management capability in terms of whatever acquisition they're doing. And then you can assess the quality of the management from there, right? So basically, this is why is valuation, what is valuation, and why exactly valuation is so critical and so important, right? So next slide. Basically, to me, without valuation, investment is gamble. Unless otherwise you are a technical analysis guy, so you are looking based on charts. So you have your methods to finding out your position to go in, your position to go out, right? Basically, that's trading is different from investing. So what I'm trying to address here is investing is sort of gamble. So for example, today you heard some of your friends saying that, wow, this company, their earnings is going to double by next year, right? But the PE now already 60 or 70 times. You do not know the number one, to deliver double in earnings. It doesn't matter what company you are buying, it's very difficult. Double in earnings that we talk about in the PE part in terms of having a overextended kind of forecast or over expected growth. What will happen to the company, right? We'll talk about it in the next 1 or 2 slides very quickly. But if you just heard someone say that this company is going to grow, even though the earnings of the company really did double, but the valuation of the company has already factored in. That means that the share price has gone up, valuation has also gone up to the extent that it reflected the future earnings of a company. Then when the earnings come out, the share price might not go up further. It might even drop because sell on facts. at the point of time. So without understanding the valuation, I think personally think investing is truly gamble. So I hope that throughout the session after this, you are able to at least assess the companies, and then we'll try to think of because valuation is an art, it's never a science, right? So hopefully you are able to work out the valuation of company after the session. Okay, so some of the key principles that you should look at for valuation. I'm going to talk a bit about time value of money, right? Our money, whether it's in your pocket, whether it's in your bank, whenever you put it there, it is working for you. By right, if you want to get rich or you want to achieve financial freedom, money should work for you while you're working for money, just like me, right? I'm working for money as well on the daytime, but at the night time, money should work for you. So that means that you are putting your hard-earned money in somewhere that is generating you a satisfactory kind of return, right? If you are buying something that is overvalued, it will not generate you return. That means that your time value of money, you are wasting the potential, your opportunity cost is huge as compared to buying something that is undervalued in that context, right? And again, to recap, to understand whether the company is fairly valued now, because I understand that a lot of people, I want to actually to address one of the case recently. I do not want to name the firm. I also do not want to name the company, but there is a particular firm that given out a target price to one of the technology companies in Malaysia. I think around 60 to 70% upside from their share price. But then the share price recently crashed. So if you do not try to assess the risk associated with that stock itself, and you try just blindly follow, let's say analysts say TP 5 ringgit, then you just go and follow, then there's a risk also. I mean, analyst report is a very good guidance for us to benchmark the valuation of a company, or we can look at how the analysts value this company, but it's never a blindly follow kind of thing. I would believe so, right? And principle of future benefits. Oh, sorry, I need to cycle back to substitution. Imagine if you are investing into something that doesn't generate you at least 4% or let's say 5% in return, then you're losing out. Okay, why do I say that? If you're putting your money simply into any REITs, the much better REITs in Malaysia, or you are putting into, let's say 4% kind of return, you're putting into FD. If your investment for 1 year or 2 year on average doesn't generate 4 to 5% kind of return, you are losing out. Again, time value of money. So your principle of substitution, you're losing out from there, right? And also future benefit, again, it's the same concept in terms of time value of money. You really need to be careful of what kind of valuation you are buying into, right? For example, again, I will use technology stock again because I think NVIDIA is coming out with results tonight. So a lot of expectation is there. Actually, the same goes for the technology stocks in Malaysia. When there is a lot of expectation onto a particular company, right? Let's say a lot of people have already bought into their story. The share price is already priced in for next 2 financial years. We are in 2024. Let's say the pricing has already gone up to 2026, right? We forecast the company will go triple by 2026, but the share price has really reflected or triple in terms of share price. And you know that even though the company is able to achieve triple in terms of growth by the end of the 2026, they still need something to excite the market that they are able to continue growth at such rate or some exciting rate. So that's the principle of future benefits. What kind of benefits you can reap from investing in this? And the last thing, the principles of valuation I would like to always address is a lot of people talk about, should I go for growth investing? Should I go for value investing? To me, I think if whatever methods you are taking, whether for growth or value, I think you need to look for something, a combination of both, unless you're a very seasoned trader. Let me explain why. If you're buying into value stock, let's say high assets, if you look into the history of Bursa Malaysia or the stock market as a whole, in our local context, a lot of companies, they actually have a lot of assets, good quality assets, be it land bank, buildings, office buildings, or whatever, cash, right? A lot of companies, let's say the cash pile after reducing debt is around 1/3 of their market cap or whatnot. So these companies are what we call value companies. But if the core business of the company doesn't grow, right? Every year, let's say it doesn't grow by more than 5%, you are losing, number one, you are losing out to inflation. Number two, the value of the company will slowly diminish, right? So one of the company in Malaysia, we're talking about, they do not have a very high NTA, but they have a huge market cap. Their dividend yield is very attractive. Imagine you buy, you just sit there. Every year, you can get up to 8% dividend yield. But then the share price actually came down from 20 ringgit to, I think it's around 8 or 7 ringgit or 8 ringgit now at the moment, right? Again, you can go look for 8% yield and above, then you know which stock I'm talking about. So these kind of companies are what we consider as a value trap because the company doesn't grow anymore or the prospects is just not there, right? And it's an industry that's getting smaller, and smaller. Effectively, there's no growth in that value stock. You cannot beat inflation. Eventually, the market will price in. And again, substitution, future benefit, you lose out from that, right? And also for growth, when we are looking into a more bullish market, a lot of times we are excited by the growth story of a particular stock, right? And a lot of times when we look into the growth, we forget to think about the leverage the company have. Leverage, by leverage, I mean whatever financing they're taking up to push their growth. For example, getting bank loans, okay, in order to buy more inventories or buy a new land bank, build a new factory, increase the capacity. All these are considered leverage. Imagine when the demand for such product has a downturn. That's what's happening right now for the semiconductor industry. Actually, the outlook is quite bad according to whatever ground information that I gather from some of my friends, right? Actually, it's quite bad now. So imagine you overexpanded in the semiconductor space or the technology space, and you do not have the demand to meet. Then slowly you have extra capacity, means you have more costs because your new factory, you have to pay utility bill, you have to pay your extra workers, you have to pay for additional inventories. Inventories putting there is also a cost, right? So all these additional costs, but you do not have the demand to meet the growth you are expecting, again, you have trouble. So growth, you have to look into their value as well, which is the cash flow generative capabilities, and also are they over leveraged in that sense, which the NTA will be extremely low. But I'm not saying that NTA low means a bad thing. There are certain companies like a IC design company, which is in the front end of semiconductor. Basically, they do not own a lot of assets because they don't need to. They are not property companies that they don't need to own a lot of inventories, contract liabilities. That means that the work that they have done that book into their balance sheet, they also do not need to own a lot of land bank. So that's a bit of difference, right? And if you're curious about some of the companies that, hey, what kind of valuation should I take for the company, right? By the end of the session, if we have the time, we will have a panel discussion part where you can comment or put in the Q&A part of the company that you would like to discuss. I would recommend put into the Q&A part, then I can see, because I saw a lot of chats. You guys are very active today, right? So number two, we are going into different types of valuation method now. Now, again, I presume there are some of you that are completely new to valuing securities. There are also some of you that are veteran. There are some of you who might has experience of 2 or 3 years. So hopefully, you can bear with me. I'm going to go through a bit slowly to explain each of the valuation methods. Okay, number one, the classic price to earnings ratio, right? It's very simple. It's very simple, really. PE is what you always hear people say. PE lower, the better. PE too high is not good. But a lot of factors can come into play. Okay, so basically to calculate the PE, it means that how many times you are buying the profit of a company. Let's say, why is PE so important? On a perfect scenario, you're buying into a company that is making 1 ringgit in profit per share, right? Per year, 1 ringgit in profit per share per year. Then the share price now is 5 ringgit. Okay, very simple. So 5 divided by earnings per share, you get a PE of 5. Assuming that this company is paying out 100% of their profit as dividend every year. So you are getting, you're going to recoup your investment within 5 years. That's a perfect scenario. A lot of times cash will be in company, but if they are growing, then the capital gain will be there, and PE also will adjust. But that one is a bit too complex. We're gonna simplify, dumb it out, to the simplest explanation. So you basically you need 5 years to recoup your investment. So PE is also one of the method people saying that how long can I recoup my investment in the company, right? And then they are also saying that the lower the PE is better. But I'm gonna share with you actually a lot of things. There are a lot of limitation of PE valuation, and I want to discuss with you one by one. Number one, to calculate PE, right? The valuation method you see here is always lag data. What do I mean by lag data? It's always historical data. It's not predictive of the future. So basically, PE is what already happened for the past 4 quarters, right? There are methods that valuing on normally is past 4 trailing quarters. That means that now we are in August. A lot of companies they will announce their Q2 result. So if you're looking their PE now, you are looking into Q3 last year, Q4 last year, Q1 2024, Q2 2024. So this is what I call by trailing 4 quarters, right? It's also the past earnings of these companies, what had already happened. So if you look at the pointer on the right side, cyclical companies, imagine that for this period of time, right? Q3 last year, Q4 last year, Q1 this year, Q2 this year, a particular commodity price has gone up substantially, right? So again, the earnings per share of the company, what will happen to it? It will spike, it will increase substantially. And if the share price doesn't move in tandem, let's say profit growth by 100, 150%, 200%, but the share price only move up by 50%. So naturally, you will see the PE getting lower because earnings is coming up, but share price doesn't go up in tandem because it is cyclical in nature. People know that eventually when the commodity price came down, the valuation will go back up again, right? So it's reflective of what already happened. So you do not know what will happen in the future yet. So let's say for the next quarter, Q3 2024, which is expected to come out by November 2024, right? 3 months ahead from now, if you do not act based on whatever information you have now, let's say in October, you see the commodity price is down for your company, then you already know that people already expected this company is not going to perform so well going forward. Naturally, the share price will come down, even though it's mid to medium high kind of PE, could drop to 4 times, 5 times. It's very normal for commodities companies, right? So it's the limitation of PE is that it's reflective on the past historical data. That's what you need to be very careful. Number two, there's one risk for new investors is that it always contains one-off item. That means that whatever happens in this particular quarter or this financial year only. And a lot of times it's non-cash in nature. Let me give you an example. So there is, let's give you IPO companies, for example. Before IPO, the company is earning around 6 to 8 million every year. But in the first 2 quarters, you normally see a slump in the profit of that company. Then you will think that, this company, you are lying to me. You say that you can generate 6 to 8 million every year, but then first 2 quarters, you already have a loss in your quarter, right? So this is what we call one-off item. They normally would have one-off IPO expenses being capitalized into their profit and loss statement. That means that this is one-off in nature. Yes, this is cash. They need to pay the cash to cover whatever IPO expenses that they have, but it will not affect them going forward. In fact, they successfully raise fund for their future expansion, assuming they're not taking it for paying off debt or it's not an offer for sale to sell off the shares, right? But that one is another topic as a whole. But for PE valuation, there is a lot of time that there will be one-off items in the profit and loss statement. So I do come from a finance background, but I'm not accountant by nature. But you do not need to really be an accountant to understand how to read the balance sheet or the profit and loss statement, right? It's not that complex. As you read more and more, then you know that, this one, there's a one-off item, non-operating income, right? Or other income. So I know that this is not from the normal business nature of that company. So when I'm calculating the PE valuation of that company, I will take it out. Then I revalue and I calculate the, again, EPS to share price. I calculate the real PE ratio of the company, right? And a lot of times this one is on the loss basis. There are cases where the company have a sudden spike in the profit. So let's say they revalue their property. This happens a lot in REIT and also asset heavy companies. They revalue their asset. Suddenly they have a capital gain or revaluation that is reflective as a non-cash item in their profit and loss. Normally, we also take that out because this is one-off and also it's not going to be recurring in nature and also it's not cash, right? So this is the limitation of PE valuation. So it's very simple to apply. Basically, just take the share price divided by EPS for the past 4 quarters, add it up together, and make sure that there are no one-off items in there, right? To make a more correct kind of judgment in the PE valuation. And also be careful. Once again, I want to reiterate this so much, is past earnings. If you are buying into the company for the last 4 quarters, again, for simplicity, Q3 last year, Q4 last year, Q1, Q2 this year, one of the quarter, they have losses. Then you will see that the PE of the company suddenly they spike up, right? Maybe 50 times, maybe 100 times, because there's one quarter that have losses. Then you need to investigate. This is one-off item. Is it impairment on your trade receivable, which is quite bad also? But if as and when maybe there's impairment or non-cash item happens that impacted the balance sheet, so you can investigate, right? So again, the myth saying that the lower the PE is better, that is true to the extent that you understand how to calculate the true PE of a company, right? It's not just open your KSC screener or open whatever app, let's say Movo app, not advertising for them, but I think that's what you guys use. Just open and then see, okay, this company PE is 5, cheap. Okay, it's not really that simple. If that's simple, then everyone would be very wealthy by now. Okay, so we move into the next valuation method. This is DCF. It's going to be a bit more complicated and complex, and I honestly wouldn't really recommend it for a beginner. But I understand a lot of you would ask me about, hey, what about DCF? DCF has been used by a lot of famous investors, including the founder of The Edge, right? If you look at his portfolio, most of his investment is calculated based on DCF, and also a lot of famous investors basically, or the funds, they're using this complicated method called discounted cash flow. I'm going to simplify it in a way. So basically, when you want to use DCF for beginner, you are trying to calculate 2 things. Number one, the next few years cash flow of the company, right? Plus the terminal year valuation of the company. Add it up together, right? So what does that mean? For example, this company, they are going to generate 10 million in cash this year. Okay. Next year, they are, let's say, assuming a growth rate of 5% for simplicity. Like every year, this company is going by 5%, 5%, 5%, right? So you calculate, let's say this year generate 10 million, next year is 10.5, and add it up together for next 5 years, for example. Then you need to discount it back by the WSCC, weighted average capital cost of the company. Don't get too complicated, but on average basis, on a conservative basis, maybe you use 10 as a more conservative basis, right? 10. Then you discount it. So because very simple, as I mentioned at the earlier slide, your money is worth more today than it is in the future, because tomorrow you might see your favorite burger store, Ramly Burger, increase prices. So your valuation of your money most of the time is going to depreciate. Same goes for the cash flow generated by the company you are investing into, right? The value, let's say I'm only going to get that cash by, let's say, 3 years after, 4 years after, 5 years after. It's natural that this pile of cash or this cash flow generated need to be discounted on top of their growth rate, right? It's a bit complicated. So I'm trying to, try my best to explain here for DCF. And by the 5th year, there's also a calculation method on how you can value the company. This is the terminal year of the company. By the end of this discounted years, how much would the company worth based on their cash flow that they are able to generate? Then you can add it up for the 5 years and add the terminal year for the DCF method, right? The challenge here is, number one, you need to dig deep into the the financial statement of the company. You need to calculate not any cash flow, but the free cash flow of the company. Okay, what is free cash flow exactly? So imagine that if I'm running a business, normally I got 3 pillars where I get or I deploy my cash into. Number one, operating cash flow. That means that on my daily cost of operation, right, I would receive cash and also deploy cash to run my business. For example, if I buy inventory, I would deplete my cash. I will deploy my cash. If I sell my inventories on cash basis, I will receive it now. But if I am selling it on a, let's say, I will give you terms, let's say 90 days. I give you the inventory now, you just pay me in 90 days. Then my cash flow will still decrease. Then you will see my operating cash flow will show a negative number, because in order to do that business, I have to give my customer a certain term. That's your operating cash flow. There are other items in it as well, like your inventory movement, your trade receivable movement, which is your customer, you have to collect from them, and also your supplier, trade payables. This is what we call working capital movement, but again, it's a bit complex. In simplicity, that's the first pillar, operating cash flow. Number two is your investing cash flow. That means that, let's say, this has, you imagine that this has something to do with your shares. If you are going through a IPO process, or the company going through an IPO process, they would issue new share and they would raise fund, right? Okay, sorry, this one is on financing. Sorry, I got it wrong. Investing, just put it on, they are putting their cash into buying PPE, property, plant, and equipment, right? This is what we call capital expenditure. Basically, it's very simple. They are investing into something that they would use it in the future. This is an asset. They are buying into something. So it's called investing cash flow. Why not operating cash flow? Imagine if I put in an operating cash flow, I buy something, buy a machine now, 20 million, but my profit is only 10 million. So what will happen on my profit and loss? There will be a significant drop in terms of my profit. So they put in a cash flow part, you can see cash outflow, but they will depreciate it over the years. Okay, so this one is on accounting terms. Don't have to go too deep, but basically, investing cash flow is whether the capital expenditure, they buy PPE, property, plant, and equipment, or machines basically is included, or they sell the PPE, right? And the final one, financing, is normally when they pay dividend or they are receiving money from bank, which means that they draw down from a loan, or they are paying back to the loan, repayment to the bank. That's financing part. So basically, for free cash flow, the formula is very simple. So you just take whatever net is in the operating cash flow part minus the capital expenditure, because a lot of companies, as you study the companies, there are actually two types of capital expenditure. Number one is what we call maintenance capex. Maintenance capex is very simple. If I run a factory, let's say I manufacture t-shirt, sorry, this is polo, but if I manufacture polo tee, so every year my factory might need to refurbish the machines, I need to refurbish the lighting, I need to refurbish the factory so that it's safe for my worker to stay inside there. So every year I would have a maintenance capex being deployed, right? That's the first type of capex. Second type of capex is that this year I'm going to expand in order to maintain my growth. So let's say I'm buying some new machinery, or I'm buying a land bank adjacent to my current factory for me to expand my capacity. So these are the cash that outflow. For DCF method, you are trying to work out what is the free cash flow. That means that after the company what is the cash generated by the company, and after they deploy the cash for growth and expansion and also for maintenance capex, what is left? And then you're trying to predict it for the next 5 years. For example, you're trying to predict what is the cash flow for that company for the next 5 years. And you need to deploy a growth rate on it, which is not easy because, in the real world of business, normally business is going up and down, right? So impossible that there's a perfect company that's growing at 5%, 5%, 5% on compounded basis every year. It doesn't happen in the business world. It would never happen, right? So it's very hard to determine the correct growth rate and also the discount rate. Any small movement in the discount rate, it will significantly impact the valuation on the terminal year and also significantly impacted the real cash flow, the DCF valuation that you will get. So if you really want to use DCF, okay, there are tools online. You can just key in the growth rate that you are expecting perpetually growing and also key in the discount rate that you are growing. I would recommend you to go for a more conservative number, let's say 3% kind of growth rate, but you discount by 10% in terms of the value of the cash flow you receive in the future. Okay. And there are also calculations where you need to remove the debt. You need to add back the debt and remove the cash to have the calculation. That one is a bit more complex in that sense. But basically, this is DCF, right? It's not easy, and also it's more applicable towards companies that are not in growth and probably not so in cyclical, but for cash cow. What do I mean by cash cow? These are the companies that are so mature, you can already predict that no matter the market up and down, their profit and loss probably going to increase or decrease by in a quantum of 5%, 10%, right? You can already have a rough idea. Let's say consumer staple products. I'm giving an example. I'm not saying to assess the company, but for example, Dutch Lady has already grown to a stage of F&N or Nestle or Coca-Cola. These companies, their cash flow is pretty much quite stable every year, unless something substantial happen that would significantly impact their demand or significantly impact their capacity to produce. If not, the cash flow on normal basis every year, it will be quite consistent, right? Okay. So this is the limitations in the DCF wise. There is a very quite complex in terms of calculation because of the discount rate or the assumption of the growth rate you need to give to that company. And also any small, let's say 1%, just 1% movement in your discount rate, your terminal value could be very, very different. And the whole DCF valuation method, 1% difference between you and me, there could be, let's say in PE terms, maybe 3 to 5 times different in the final valuation of that company. So DCF is very good valuation method for stable companies that are, again, I had mentioned just now, growth versus value investing. You need to invest in companies that they are generating good cash flow, but they are also growing at the same time. If not, if your growth rate is negative, you will not get a DCF result out of it, right? So you need to apply the correct valuation to the correct companies, in short. Okay. So the third one, let me go a bit quickly because we are running a bit out of time. Let me go a bit quickly. The third one, comparative valuation. So this is also the last valuation method I will mention in this slide. You might ask me, hey, where's NTA? Where's dividend yield? I would talk about it in the comparative valuation and also by the end of it, right? Basically, for comparative valuation, there are two types of things that you compare against. Number one, you compare the valuation of the company. Let's say you are using PE for simplicity's sake. Okay, you are valuing the company based on peer valuation basis. Let's say I'm doing manufacturing again for simplicity's sake. I'm manufacturing polo t-shirt, right? I have a valuation on my company of 10 times PE. Then you look at another company, they are also valued at 10.5, another company 12, another company 8. So this is, you can gauge that, okay, this is roughly what kind of valuation that the market, Mr. Market will give to this kind of companies. So you can have a peer valuation on it, right? But again, when we talk about PE, oftentimes, back to the few slide, there will be a lot of this kind of things that impacted. So you see suddenly a company, they have 20 times in PE. Maybe they have a one-off non-cash item that is impacting their profit so that their PE is higher. Again, because share price is there, but EPS decrease, so their PE will become higher. Okay, so this is peer valuation. And also there's another way, historical valuation comparison. This is one of the benchmark that I would like to refer, but not solely depend on, is that I'll look back on the 5-year historical PE of that company. There are tools out there that allows you to do that. So let's say this company, I just stumble across, they're trading at 15 times PE valuation. And if I look at the past PE of that company, has been, for the past 5 years, has been always trading at 20 times PE. So now I need to figure out why this company is trading at a 25% discount as compared to their normal historical valuation. Now I need to find out, and if there's an opportunity there, I'm already 25% lower risk than I'm buying at 20 times PE. That's just an example, looking and refer back to the historical valuation comparison. Now, limitation to this, I give you another example first. Looking into REITs, real estate investment trust, basically you're the beneficiary of some properties, right? So you're comparing 6% yield to 5% yield. That means that if I put in 100,000, I get 6,000 in terms of dividend, and another company, I get 5,000 out of dividend. So when you're comparing both, naturally 6% is naturally better, but you need to also look into the asset quality. It's not so straightforward that, okay, 6 is higher than 5, so 6 is better. No, you also need to look into why this company is trading at 6% yield. Maybe their recent performance for, let's say, take easier example, retail REITs. So their portfolio of assets is not so good. Performance not so good. Their occupancy is dropping. That means that the tenant for their malls is getting lesser and lesser because of a lot of competition coming from malls. There's a fact, a lot of malls is coming up. So a lot of people sell their shares in advance. Again, dividend yield is also a measurement of past dividend that they have already paid, right? So if the share price drop now, because people anticipate that the company is going to perform, or they are going to deliver a lower profit and also a lower dividend, so they might sell now. If you look forward or you're trying to forecast the earnings of the company, it's actually the same. Vice versa, if this company, they are trading at 5% dividend yield, but recently they are just acquiring another high quality retail, let's say another high quality mall, right? So now their share price in expectation, it went up a bit first, but you know that as they include the new mall into the new shopping mall into their numbers, so you know that the dividend yield of this company is likely to increase, because to enjoy the maximum tax benefit, REITs, they need to pay out at least 90% of their distributable income. Okay, a bit hard to pronounce, sorry. But basically, that's it. They need to pay out 90% of the profit that they earn to enjoy the maximum tax benefit. Okay, so peer valuation comparison and historical valuation comparison is a very good method for you to have a sort of benchmark, trying to understand the benchmark of this company. So again, to recap, my peers are trading at how much, and historically this company has been trading at how much, so that I can gauge. I won't be or I give you another scenario. So I'm buying into this technology company, right? Historically, this company is only trading at, let's say, non-consistent, because tech companies, right, growth can be quite a roller coaster basis. So let's say the company could go 20 times PE, 10 times PE, suddenly 30 times PE, then go back to 1-2 times PE. It won't happen. Maybe negative PE because they have losses. So it will have a roller coaster kind of thing. Suddenly, I saw that the company now is trading at a reasonable 10 times PE. Then I can refer to their historical. I know that their growth is not consistent in the past. If not, their share price has been not consistent. If not, their historical 5 years PE valuation wouldn't be ding dong like that, right? And I can look into their recent performance. Is it they're getting more stable? And if they're getting more stable and having a growth, right? I know that this company, it is the time. It's more safer for me to go in at this moment as compared to a more volatile situation. For example, for the past 5 years, they have been trying to go into new markets, right? For example, they're trying to go into Vietnam, go into Indonesia, go into US, go into Europe. But at a PE of 10 or 15 times now, they already successfully penetrated into that market. So the story is more stabilized in terms of the expectation, their earnings, right? And if the company is able to deliver consistent earnings, So this is one of the way that you can view or review the past of that company itself. Okay, but again, like I mentioned at the very beginning of the webinar, there is a limitation to whatever valuation method, and there's no one size fit all kind of valuation. Okay, we can discuss about this later. And is that the difference in business model? So maybe I'm more skeptical on this. I'm a bottom up guy. That means that I study a company first, then I look into the sector they are in. So I'm more stringent in terms of studying their business model. For example, you're talking about a plantation company. Then next question I will ask, what kind of plantation? Are you durian plantation? Yeah, durian is quite hot now because the export market in China is very, they just gotten the export license, so it's quite strong in terms of expectation, right? Or are you doing palm oil? I can say 90% or 90% and above the plantation companies in Malaysia, they are doing palm oil because we in Malaysia, we are the second largest palm oil producer in the world. Number one is Indonesia. So 90% of the time, they are palm oil companies, right? Then just an example, when you compare durian plantation and palm oil plantation is two completely different things, right? It's two completely different things. Number one, harvest cycle is different. Number two, volatility in pricing is different, right? Demand is different. So you cannot really have a straight line. Let's say durian is trading at 6 times, then palm oil is 5 times, so palm oil is cheaper. No, that doesn't work that way. Or in the same value chain, let's say, they are doing semiconductor, but what kind of semiconductor? Are you doing precision engineering? Basically, to put in a simpler way, that means that they use very sophisticated machines to cut the metals into precision parts. That means that the tolerance is very low. The parts need to be accurate in terms of their sizing or in terms of the ages and whatnot. And another company, they are doing machines. So let's say Malaysia, we are known for back-end semiconductor. Basically, simple term, they are doing testing machine, right? How can I compare a testing machine company to a precision engineering company? It just doesn't make sense. So when you're using comparative valuation, you need to dive down deeper a bit into the company. Let's say I'm comparing plantation to plantation in terms of palm oil. Then it makes sense. Then we can know that who is performing better and whose valuation is cheaper. Because we have a time cost. The best we can do is select the lowest valuation, and we know that they have growth. In terms of peer, they are the cheapest. Then we have a certain advantage. Okay. Number two is also when we are using comparative valuation. Even though I'm doing precision engineering, let's say my end client is different. So your end client is doing AI, right? My end client now is doing EV. So which valuation do you think will be higher, AI or EV? Very simple. The answer will be AI. So you cannot apple to apple comparison in that basis. Same goes for testing machines in Malaysia. If my end client is doing for AI and your end client is doing for EVs, which if you look into the US and Euro market EV now, China has a very fierce competition over there. And it's basically sort of a bit of price war over there. And in compared to EV, AI is going definitely a more linear market, right? And also there's also a peer comparison bias. What do I mean by that? There are certain companies, this is factual, and it happens in Malaysia a lot. There are certain companies in Malaysia, they are very good in marketing, or they are willing to come out and talk and give guidance, and there are a lot of analyst coverage. There are also a lot of companies that their management is a bit more shy, not that they cannot run the business, but they are focused on running the business, but they don't come out and talk about their business and whatnot too much. So that is where when the management come out and talk, there are more marketing activities like webinar to explain about your company on a quarterly basis and whatnot. So a lot more people will know about the company. They can get more access of information to that company. So you have a peer comparison bias whereby the valuation of the company with higher transparency will almost always have a higher valuation than those that are more quiet. This is the truth on Bursa Malaysia. I think not only Bursa Malaysia, basically the market as a whole. Because very simple, you cannot invest in a company if you do not know who they are even, right? So even though in the same industry, there might be things like that happening. And again, temporary distortions. This one we already covered quite extensively in the PE valuation part, where there are one-off items, there are unexpected downturns of demand, and also commodity prices up and down that impacted the profit of a company and ultimately impacted their PE. Okay. So we have a bit of time before we move into the Q&A session. This session is supposed to be a case study session to talk about the different valuation methods, right? So if you have any particular companies that you would like to discuss, again, I'm not allowed or I'm not licensed to give you any recommendation. I can only comment on what kind of valuation is probably more suitable to discuss on this kind of companies. For example, plantation probably you use PE, okay, or forward PE to calculate on them, right? Okay, we got the first one, my EG. Okay, let me stop sharing for a while. Okay, it's like stagnant. I hope it's not now. Let me share. Sorry, let me share the screen shortly.
Yeah, it was all right.
Okay. Okay, ignore the company. I was just shopping around. So first one is my EG. Okay. Again, this I mean there are a lot of tools and a lot of platforms that you can actually use to look at the valuation movement or the financial performance of that company. If I'm not mistaken here, sorry, I'm not subscribed to premium, but you can look at the valuation here. Let's say for PE sake, you can look at the PE now. According to this website, is 11.5 at the current moment. So next question we're going to ask ourselves is 11.5 or PE suitable for this company? So what does MyG do? To my best understanding, they are software-based company with a lot of strong concession projects with the government. Okay, so to me, I'm not trying to discount MyG, but to me, when you have a single client risk, normally I would reduce a bit in terms of the valuation I'm going to give. Okay, next is to look at their financials. Basically, if you're trying to figure out the growth rate of that company, I think MyG has done quite crazily in terms of their growth since financial year 2019. You can see over here, their profit has been growing quite consistently. If you're trying to analyze, okay, analyze means that whatever profit you have now, let's say for 2 quarters, then you times 2 equal to 4 quarters. If you analyze, this year's growth is even going to be even more substantial, right? And then you're trying to figure out the growth rate for every year. What is the growth rate? And you're trying to match it back to the PE that you are seeing here. That is the conventional PEG, price earnings to growth valuation. I didn't talk about it just now because again, it's quite hard to go and expect or forecast the growth rate of a company unless it's something that has continuously, or some companies that have continuously proven themselves able to deliver despite market up or down. Okay, and I think MyG there has been experiencing quite a bit of downfall since the change of the government back then, because a lot of people worrying they're going to lose out contract. But I think that a bit of prospect here, but I think that the Zetrix crypto is going to do quite, I'm not going to say well, but in terms of market caps, Zetrix is quite big actually. Recently, why I was looking into Zetrix is because I'm looking into Egmore, one of the companies that they used to be the substantial shareholder, but they distribute all shares that they hold in Egmore to the shareholders, which is one of the good move. And I was looking into Egmore. Egmore, they have a certain share in Zetrix as well. So MyG, they are doing the Zetrix coin, and a lot of good symptoms coming for this company. So you try to figure out 2 things. If I were to value this company, 2 things. Number 1, will they continue to grow on the growth rate that we see here historically? And number 2, their valuation compared to their growth rate, is it at 1? Okay, so very simple. PEG, we're going to talk a bit now. PEG, the method to use is very simple. It's basically your PE currently, let's say 11 times, divide by the percentage of growth you expected. Let's say if you expect the company to grow by 20%, PE is 11, then you get around 0.6 kind of PEG. So normally anything around 1 is fairly value for PEG. But this, again, the complication of calculating the future growth of that company is not so straightforward unless you really understand that company. So yeah, that's for my EG's case. Okay, so let me see. Okay, I'm seeing maybe one last should we move into Q&A now? We can
Yeah, we have
integrate.
a number of companies choices in chat, like
Yeah,
Genting, Sam Darby.
right. Okay, Genting is a bit tricky. Okay, this is Genting. I will use Genting to I will use this opportunity to talk about a valuation method which is I would say very complex as well to discuss about it. Okay, Genting. It's very interesting that if you look into their is it my internet a bit slow? Oh, apologies. Let me go to another website that I can share the information. Okay, sorry for being a bit of cheapskate. I'm not buying any premium software as of now. So if you get a shout out, anyone want to sponsor us, so feel free to do so. Just joking, we are not supposed to do any promotion. But okay, different platform. So Genting is a very interesting company. If you look at the PE now already come back, they used to suffer a lot due to the COVID-19, Genting, without needing to say. So Genting is a bit complex. They are in the travel, leisure, and hospitality sector, which I would say is a bit of cyclical in nature. There's also a risk to gaming companies, which they need to renew their license continuously, and they are very subjected to the gambling tax implementation, right? So these kind of companies, you need to monitor very closely on regulatory change. Okay. So Genting, if I remember correctly, Genting Malaysia is the one that pure play, the leisure one. But for companies, let's say the old Sam Darby, they have different kind of businesses. Then you might ask me, company, let's say their segment A is something more stable, segment B is something growing. Then how should I value this company, right? There's no way that I can use a one size fit all. Okay lah, you have one stable business, then I just give you a 10. No, this is where it gets interesting. We are going to use a valuation method called sum of parts, SOP. Sum of parts you might see in some of the analyst report in there for companies that have different kind of business. Normally they use SOP. So SOP basically is to figure out the fair PE valuation of a company, okay? Or it's a bit complex. Some of them, they use net asset for a particular segment, right? For example, if I have a plantation business that is expected on an average basis on CPO prices is maintaining around 3,000 per metric ton, right? So I would expect the plantation segment to generate, let's say 100 million profit to me every year. Then I use a 8 times PE valuation on my plantation segment. That means that my plantation segment is worth 800 million as of now, before anything changes. Then I also have another business, which is manufacturing, for example, something completely different. Manufacturing is doing something related to, let me think, something more interesting. Let's say electronic parts, right? I'm doing manufacturing for electronic parts. It's completely not related to my palm oil business, but it is still in my group, right? So I will use a higher PE valuation for that business and to calculate the market cap for this business. Let's say for my manufacturing business, I'll give a 15 times PE because there is a higher expectation in growth for my manufacturing segment. So it becomes, let's say, 100, again, for simplicity's sake, 100 million times 15, 1.5 billion plus 800 million of my plantation. So my company fair value based on sum of parts is 2.3 billion. Assuming I have another business, this is true for a lot of conglomerates, companies in Malaysia. That's why their PE is always low because too complex to calculate, right? they have something that, let's say concession. Let's say they own a turbine that generates electricity. So every year the cash flow is basically quite stable. So maybe the analysts, they will go into it and use discounted cash flow, let's say to calculate another billion based on DCF valuation for your energy business. So they add three together and then they calculate the market capitalization for that company. So for this kind of company, you cannot just look at their dividend yield or just look at their PE and jump into it. It's a bit more complex when you're trying to value this kind of company. So this is the SOP, sum of parts valuation part, which is a bit too long to talk about and also too complex to put in the this valuation supposedly for beginner session. Yes, I saw some of our friends here has correctly pointed out some of the companies here. Conglomerates like YTL, Sunway, PPB, one of the companies that I always looking into because it's a great businessman. MegaFirst is the one that owns the turbine energy business that consistently making money, cash flow every year. But again, what kind of valuation are you giving these companies is completely up to sum of parts segment. It's not easy.
Thanks, Max. So if any questions are asked, Max, please write them at the Q&A box here. So the next question is from Eugene Wong. What is the optimal valuation for TTVHP? AFAIK, the closest peer is Vitrox, which is trading at a crazy premium. Another is QES, but they are a distributor which market value is lower. Any other peers that we can compare with?
Okay, I'm going to go a bit, since I know a bit about these companies. We're going to talk about TTVHP, TT Vision first. You guys can see my screen now. I'm showing TT Vision,
Yes.
right? Okay, cool. TT Vision 37 times PE. So, and you were mentioning the peer is Vitrox, which is 67 times. Okay, Vitrox, they have a high valuation. I think it's something to do with them being named in the AI kind of announcement. I think that's one of the, again, high PE because of high expectation, but you also need to factor in whether that they are able to deliver that kind of substantial growth in terms of valuation. Okay, so in terms of the things they do, again, when we talk about peer comparison, this is a very good example. TT Vision, they are supplying more towards solar, LED, and some back-end semiconductor segment. For basically for semiconductor, they're doing a bit of back-end semiconductor. I couldn't recall correctly which particular subsector, but it's basically solar. It's quite huge for them, and also LED part. I think they're supplying to, if I remember correctly, it's the subsidiary at DNO, and for the back-end semiconductor. Then TT Vision, they do not manufacture, as far as I know. They do not manufacture the parts, but they do design, assembly, delivery, and commissioning. Vitrox, on the other hand, if you've seen their factory like a university campus in Batu Kawan, is effectively a manufacturer and designer and also delivery to their client for vision testing and also functional testing equipment. So if you want to put in the context of automated tested equipment, yes, in a big context, you can compare them in that context. But the client that they serve, Vitrox, I think they're serving a bit more. They have the exposure into AI, I believe so, because their PE valuation is much more extended as compared to TT Vision, even though after the split. And TT Vision is more towards solar and automotive, and semicon back end. So like the example I given just now, so there's a difference in terms of business model and also the end client that they serve. So why is end client so important? Is because by knowing their end client or the segment of their end clients, we can roughly gauge their growth rate or growth in the future, right? So, and you mentioned QES as well. QES is a bit special. If you want to go a bit technical, you can also use some of parts on them because they have different business segment. Number one is the distribution of some instrumentation equipment and also semiconductor equipment. Number two is that they do maintenance and also servicing and also replacement of spare parts. If I remember correctly, they generate around, according to a report, I think around 40 million revenue per year. It's quite consistent on that part. So you can see there's a different kind of business. Distribution is subjected to the demand and supply. Maintenance is quite fixed, but in a sense, the more that they distribute, the more they get to maintain and supply spare parts too. And the last one, they also have their own manufacturing arm, which is slowly building up. So this kind of companies, to put it in a simple way, yes, peer comparison is one of the good way. Second way I would probably use is PEG. I would try to figure out what kind of growth rate that can deliver to me. And I will trying to figure out whether their PEG is reasonable at 1. Or if the prospects is really so good, then I price in a little bit more, maybe 1.1 in terms of PEG. Right? PE wise, again, it's reflective of the historical. Okay, Shane, maybe.
All right. How about this AFAIK? It was also mentioned in the.
I think it's the acronym for as far as I know.
All right.
Yeah.
The next question is, can you comment about Sime Darby valuation?
Okay, Sime Darby. I think they split off into 3 companies now. I'm not sure what they do currently, but judging from their profit is again, I'm judging based on whatever I see on the surface. I have not go deep into Sime Darby after the split. So basically, you can see that their profit after COVID, we take after COVID, 2021, 2022, 2023, and recently there's a spike over here. Okay, so and the valuation now is quite, I wouldn't say expensive. 5 times is not an expensive figure, but I would say that there are something very substantially happening in financial year 2024, which has caused their profit to more than double currently, right? So we need to look into what is the reason for this and also whether it will be sustainable. But if you take a step back, right, for Sime Darby, even though they did not deliver 3.3 in the future, let's say they deliver 1.5, the PE is still around 10 times, maybe around 6 times, to be precise, around 6 times in terms of PE valuation. Dividend yield, I slashed by half, around 2 point something to 3%. I do not know their dividend payout ratio, but assuming it's a reasonable rate of around 40 to 60%. So if you slash everything by half, then you get the rough number. For this kind of companies, Sime Darby, I think they still have different business segment. Number 1, you can use some parts. Number 2, you can look at the historical PE performance of this company. So yeah, that's how I would look into Sime Darby.
Thanks, Max. How about Shinyang Group?
Okay, shipmaker Shinyang. Recently they have a very significant announcement that driven their share price up. This company, as you can see here, is quite interesting. If you're going at value at NTA, this is one of the good example company that they actually utilize their asset in favor of you, in favor of shareholder. Instead of they holding the pile of cash in the company, there are some companies in Malaysia, again, don't want to name them, holding the cash in the bank, waiting to go privatization, right? But for Shinyang, they are doing something recently. I remember their cash pile is very strong. They have a very huge cash pile. Last time, before the spike, I think it was 1/3 of their market cap, at least their net cash for Shinyang. And recently, they have just announced, I think they're shipbuilder, so they're in the transportation and logistic services industry, right? So they recently bought over a business, I think at 2 or 3 times PE valuation. It's very cheap, but I think it's a RPT, related party transaction, in which this is related to the owners of the company. But okay, so you need to value Shinyang in future. You need to use some parts already, because whatever they are doing historically and the new, I think, automobile business that they are bringing in, I think it's distribution business. Whatever they are doing, I think is a bit different. So in that context, you need to separate both business, calculate the market cap for each business, sum it up again, and compare to the current valuation of the company. Otherwise, if you use PE, I think PE after completion of that acquisition, if it goes down, because you are buying a cheaper business, which at no dilution. Number 1 is no dilution. They are not issuing new shares to dilute shareholders to raise fund to buy the business. So PE, with the inclusion of new business, definitely it will go down. It will become even cheaper in that context. Dividend yield, I don't know whether they can maintain or not because they just use I think 100 over million, 100 or 120 million to buy the new business. So probably dividend yield could be adjusted a bit, but PE in terms of valuation, they used to be trading at around 5 to 6 times PE, but already jack up to 8.7 now, as of now. So number one is sum of parts. Number two is probably in PE kind of context.
All right, thanks for sharing your perspective in this counter. How about Great Tech?
Great Tech. Okay, Great Tech is another interesting company that they are a bit again. When you see the company with growth expectation, it's always a bit roller coaster in terms of share price, right? So Great Tech, I have not been following them for some time already. Last time, major client is one of the largest solar panel manufacturers in the world, and I think recently they also gotten a fair bit of new customers as well. And to value this kind of companies, as I mentioned, for QES, Vitrox, and also for what's it called again? TT Vision, you need to use PEG. You need to figure out the future growth rate of this company, right? And historically, I mean, except for 2022, 2023 is still growing, and 6 months period. Let me see. Yeah, 6 months period for 2024 is already at 80. If you analyze it, you become 160. There is still growth, but question to you: is it worth 34 times in terms of PE valuation? Is the growth really so substantial that it deserves a 34 times in terms of PE valuation? That one is up to you. I think, and probably analyst reports they will have a higher profit forecast number. I don't know, but you can look into it. If the growth, in your opinion, thinks that it justify, then yes, PEG again. You're trying to figure it out. What kind of growth are you looking to get from technology companies like Great Tech?
Thanks, Max. So the next counter asked by Afnan is SDS Group Berhad.
Okay, SDS, interesting. I just go back and read their prospectus recently. So SDS, if you look into them, they've been performing very strongly. For those who do not know, SDS is actually the manufacturer for braids. Okay, they also have if you're living in Northern or you're living in Cyberjaya, then you know they have their branch called SDS. Basically, some of them are bakery, some of them are cafe come bakery. So some of them in Aeon, I think mostly in the southern region, you can also see their existence. They have a retail segment. They also have a wholesale segment. Wholesale segment is on their manufacturing of the breads. They have a lot of different kind of breads. I think each month they roll out a new kind of flavor or whatnot, right? So they have manufacturing segment and retail segment, but it's up to you whether you want to lump it together because it's interrelated. They also supply to themselves, to the retail outlet, for the bakery, and they also sell to third parties. They also OEM to Singapore, if I remember correctly. So for SDS, the valuation I would use is probably on PE and also try to look for peer comparison. There are some peer comparison, but I think their earnings is a bit more volatile. But in terms of SDS, what's interesting is that they are the owner for top baker brand Dailies. If you consume breads or croissant on a regular basis, probably you've seen these brands before. So SDS, their recently is more related to their growth because after COVID, effectively, okay, in the bakery market is like that. There are big players on control product. Control product are like your roti, like gardenia, whatnot, right? Those are control product. But for chocolate or vanilla or jagung, whatever, those are not control product effectively. So SDS is more on non-control product. So pricing wise, more flexibility, right? And they are on I always look into this kind of business like a logistics kind of business. Why? If you have disruption in your logistic delivery, your wastage will be high because roti can only stay on the what we call stay on the stands of your customer or whatever retail shop that you are displaying for so long. 5 days is very maximum already. If you're trying to do any longer, you impact the taste, then your brand will suffer damages. Okay, so that's for SDS part. They are growing recently. If you look at their numbers on annualized basis, so you're looking at them, they are doing quite decently. They're doing quite recently. This is only one quarter's kind of result. Again, if you're using PEG growth rate and you try to analyze, then I think you can get some different numbers. Because I think on these 2 financial year, their utilization rate for their factory is not perfectly optimal. But I think as their demand is higher, they're doing better and better in that sense. And also we're diving a bit deeper. When you're looking into manufacturing companies, one of the factor you need to monitor is again also commodities. Why? If you are looking into shirt, okay, let's say you need to look into cotton prices. Cotton prices can impact the cost of manufacturing shirts, and if it's too high, your customers may not want it. And recently, for manufacturing for bakery products, the price of sugar are quite controlled. The price of flour is quite I think it came down recently, and also for some creams and whatnot, also quite controlled or stable at the moment. So I think this is what caused their margin improvement. But again, that's not relevant. I mostly, based on whatever they are doing now, it's more likely that I will use growth rate to try and figure out their valuation going forward. And to recap, after COVID-19, a lot of smaller bakeries, they actually shut down because small, like home bakers, they don't have business at the time, so they have to switch. Then effectively lesser competition to their cafe and also bakery business. Yeah.
All right, thanks, Max. So the next question is by Zulkarnain. Can you share your view on CloudPoint?
Okay, CloudPoint, I think cybersecurity services and also software company. Okay. Again, I do not know what they really do, but I remember it's software and cybersecurity related. For this kind of company, again, it will be more relevant for technology companies like this to look into their growth rate, because this is a growing sector. Okay, and when you look into their financial performance, you need to monitor closely on their growth rate on a quarterly basis. Might not be, you have to grow by 30-40% compared to your last quarter, but at least year on year, they are continuously growing. And the same for technology business, for growing businesses, you can use the growth rate, PEG, to assess this kind of company based on your expected growth rate on this kind of companies. Yeah.
All right. So what do you think about KGB valuations?
Okay, KGB is a bit complex. This one, you see their sector is industry engineering, but if you look into their clients, it's all semiconductor, and it's not conventional, normal semiconductor players. Those are big, I think, front-end semiconductor players. But in terms of the nature of the business, if you look into the profit margin of the company, right, is relatively below double digit. Why? Because they are construction and engineering company, right? When it's construction and engineering company, okay, I know some of you probably would ask some construction company names. For this kind of companies, you cannot simply use PE. You cannot simply use NTA. You need to dig, or whatever method that you use, try to find out what is their order book for the next few years. For example, let's say they have an order book. Let me analyze it. Okay, so for example, let's say they have an order book for this year. Example, I do not know the exact figure. Example, they have another order book for 1 billion until end of December. So you know that, this year their revenue is going to be flat. And if I going to use the same profit margin, probably there will be not a lot of growth, right? Then you can use a reasonable PE valuation back to assess, right, for this company. But judging by the looks of it, I think they are very good, quite a lot of expectation that the company is going to deliver more contracts in the second half, because the company is now trading at double-digit PE valuation. If I remember correctly, you can also look at this kind of companies. You try to look at the historical PE. I think it's around low teens or around high single digit last time. But of course, as they secure more and more contracts, their margin also increased quite substantially for KGB, right? So I think the valuation method also changed. It could happen over time, right? Um, if a company profit margin continuously to improve, people will price them more premium. Like, okay, like one more. Last time is 12, now it's 15. It could happen. But for companies like KGB on contractual basis, you need to figure out how much contract are they going to consume or deliver or utilize by this year. This is normally you can assess by their unutilized order book, or unutilized order book. That's one of the term. Trying to figure out what kind of earnings they could get this year and next year, and use a reasonable kind of PE valuation on it. Yeah, that's how we'll look at this kind of companies.
Right, thanks, Max. The next counter that Aiman would like to ask is MSM.
MSM, okay, MSM is a bit tricky because on top, okay, it's not really a commodity because in Malaysia, refined sugar is quite controlled. It's a control price kind of company. And the share price, as you can see here, they recently delivered a loss for the quarter. So it's a bit of problem. I think it's because they are, I think it's R11, which is their raw material, the price has increased. The raw material price increase and also the subsidized is one of the issues. So the company has, if I remember correctly, has a couple of things that you need to monitor. Number one is the utilization factor of their factories, whether it's being utilized on a higher level. Basically, for manufacturing business, it's very simple. The higher my factory's utilization, the lower my cost per unit, right? Because there are a lot of fixed costs involved. And MSM, I think, is quite similar. They have a lot of fixed costs. Let's say your factory run at 30% or your factory run at 50%, the money that you pay to your admin staff is the same. But for OT staff, it's different. Then you need to pay OT, right? But your fixed cost base is low. So for MSM, I think if you want to value the company, again, I will use PE. But for this kind of company, I would be more observant in terms of the government policy changes or expectation in some tax, let's say sugar tax coming in carbonated drink. So would it impact the demand from their clients? Because their consumer end is getting lower, would it impact them? And also government policy. What kind of policy is being announced? Is it beneficial for them? Or will MSM continue to have losses on this basis? So for this kind of company, it's a bit more tricky. You need to rely more significantly in terms of the change of government policy and also the commodity prices, which is the raw sugar that they consume to make refined sugar.
Right, so thanks, Max, for addressing all your questions for how do we use valuations on different counters that we have on Bursa Malaysia. That's all the time that we have for Q&A with Max. So, ladies and gentlemen, just heard from the founder of Want2Invest, who is Mr. Max Tan. So thank you so much, Max.
Thank you so much, Shane, for having me, and thank you, everyone. I'm sorry that some questions that we couldn't justify. Hopefully, in next session, we are able to see you again. And once again, thank you, everyone, for joining today. I'll see you again. See you guys again.